It's week 11, and we're almost done with this course. Um, so if you haven't noticed yet, based on the announcements, I have posted case study 2. The same conditions apply, just as case study 1. You are allowed to work in groups at your choosing. You can choose however group members you want in whichever section, as long as you submit one version of your solutions onto Canvas, and that's it. So I'm not going to regulate the size or who you're going to make groups with, and you no need to ask for permission either. So just make sure you notice that the deadline is not at the last day of class, right? It's at the last day before your exams start, I believe. So there should be plenty of time to finish, regardless of which section you are in. So I hope, no complaints about unfair advantage here. I will give you a brief overview of the case today, along with some tips and guidance. And again, I hope these tips and guidance are sufficient for you to complete the case study without much confusion. As I think it's relatively straightforward as long as you know what you're doing. All right, so let me see. Yeah, so just pay attention to the deadline is the 27th, not the 16th, right? Or the 15th or the 17th. All right, so today I am going to talk about two things in addition to going over the case study hints. Futures and forwards, which you'd already know, as we talked about the covered interest rate parity, but I'm going to go into more detail in a generalized manner. So rather than just focus on currency, delivery of current foreign currency as the underlying asset, I'm going to generalize it to basically anything, a commodity, whatever. Again, this is so that for those of you who are in accounting majors, and not much exposure in derivatives, pricing stuff, I need to start everything from scratch. So for those of you in finance, just bear with me, but at least I hope it's a good review. And again, my objective here is to emphasize intuition as opposed to the nitty-gritty details of proving stuff. All right, I'll leave the proofs for the other courses. This is a very applied course. So I'll talk about futures and forwards, but more precisely, I will talk about how to use these contracts to hedge. So not just hedging until the end of, a specific investment horizon, but I'm also trying to generalize it so that if you choose to unwind your position, that's also a feasible option now, because I'll tell you exactly how to identify the optimal amount of forward or futures contract you want to take on, so that you're minimizing risk, or just in our sense, the variance of your portfolio. All right. So that's my objective today, to give you the extra empirical tool now to kind of define what you're trying to do as a risk manager, minimize risk. And in doing so, once you define your objective, you can, solve for some equation so that you can find an optimal level of hedging contracts to obtain to hedge your position, right? To fulfill that objective. All right, so after completing that discussion on futures and forwards, of course, I will try to link futures and forwards stuff in a generalized manner with CIP, so that you'll know that whatever I talked about today will also be applies to, or it subsumes what I discussed up, week 2 to 3, when I talked about the no arbitrage proof to prove that CIP has to hold. And you'll realize that these two proofs, the generalized method versus the specific method of arbitraging, interest rates are the same. And it's you'll hopefully see the connection fairly soon. All right, so after futures and hedging with futures, I will begin discussion of option pricing. Again, I realize that many of you must have had exposure in your derivatives course, but again, for those of you who are in accounts, not much exposure, I'm going to start from the ground up, define the contract, and why option pricing is fundamentally different from pricing futures and stocks and bonds and so forth. All right. So these are it's a completely different set of mathematics, and there's a good reason for that, but I probably won't get to that until next week. So I'm going to just talk about the differences between options and other contracts, and then just show you how to hedge with them a little bit. And then next week we'll finish up options, and then a new topic on introduction to cryptocurrencies. All right, so that's the trajectory, that's the plan. And then of course week 13 is just review. So you should start compiling questions and be prepared to ask them on our last class together. All right, so let me give you some hints on the second case study. All right, so the second case study is takes place takes place in the 1980s. You are working for a US bank and your job is to help restructure a country's debt. All right, and the reason why this country, Mexico, needs help because their existing debt is causing them to basically go bankrupt or default. And the reason why is because they denominated their debt in a foreign currency. So usually you would imagine if you were to issue a debt for a country, that debt would be denominated in your own currency. But it may be helpful, for example, for emerging economies to denominate their debt in other currencies because you allow investors to trust your bonds that you issued more so than those bonds that are issued in, for example, Mexican peso. Right? Did they trust dollars? They don't trust pesos. That's fine. But of course, you just have to realize that you're exposing yourself to additional sources of risk beyond the ones that that may affect your local economy. There are now external factors now that may impact your ability to service the interest payments and pay off your debt. So that's the general context, all right? So let me give you some description of vocabulary that you may encounter in the case studies so that, again, there are no unfair advantage in somebody having exposure to, for example, fixed income. I'm just going to give you definition outright so that we can resolve any discrepancy in an understanding across between you guys. All right, so let me talk about these set of vocabularies terms. So collateral, I think most people know what that is. It's something you have to pledge in order to get a loan, right? And usually means that the loan is asset backed. So things like home mortgages, for example, is a loan for you, but you have to collateralize it using your home, meaning that if you default on your payment, your creditors can get the house and they can liquidate it and recover some of their principal, right? So, of course, collateral doesn't have to be a physical commodity. It can be financial assets. You can pledge stock. You can pledge more safer bonds of other countries as collateral. Basically anything. You just have to pledge it before you get a loan, right? And it just allows the creditors to recover some of their principal if they fail to receive interest payments or the principal at the end of before maturity. All right, zero coupon bonds we talked about last week. It just means that bonds without coupon payments, no intermittent payments, just one final bullet payment at the maturity. Just like stocks, there is also a primary and secondary market. So stocks, you have IPOs, right? Initial public offerings as the primary market. That's the initial creation of securities, equity securities. For bonds, it's the same thing. It's bonds instead of being, issued on the open market, it's auctioned off in a first best price auction or first best price auction. So basically, there is a consortium of banks that take bids on behalf of everyone else. They submit these bids to the central bank, and the bid with the highest price would get the amount that they desire. And then they go down the list of the next best price, etc., until all bonds are issued out. Right? So it's a first best auction. After they are issued and sold by auction, if there's additional trading between institutions, financial institutions, hedge funds, other central banks, whatever, it would take place in the secondary market. So just like the equity markets you see in the day-to-day price fluctuations, the same thing. You have another market in which it's not the primary market anymore because it's not minting of new securities. These are just old securities that are changing hands between people, investors. LIBOR, we mentioned last week about swaps, right? LIBOR is just the overnight rate that they used to use before the scandal, right? There was like people making up numbers right? And then nowadays, now every region now has their own overnight rate, but before this was the traditional benchmark, the LIBOR rate, the London Interbank Overnight Rate. Yes. So it's floating, meaning that it fluctuates day to day. So whenever you try to create a new floating security or bond, and you want the interest rate to fluctuate over time, this is what they use. So if it's a mortgage rate, or just a uh, generic corporate bond with a variable rate, they usually have a margin on top of the LIBOR rate. That's what they use to determine the coupon payment. All right, so that's LIBOR. And these two terms with regards to American issued government bonds, they're called treasuries. So we all know what treasuries are. They're debt issued by the US government with semi-annual coupon payments. So that's the key difference between Chinese government issued bonds versus US. US is semi-annual. And just to note that uh, there's a market for everything. So there are institutions that decide to repackage treasuries into different type of securities. And a notable new type of securities that's created from the markets is called US Treasury strips. Strips means that they take one treasury and they disentangle the product into two separate securities. So one is just a zero coupon bond, meaning there's a final bullet payment at the end of maturity, and then you have the other, just the coupon payments, as a separate security that is traded. This is great because, again, market for everything. Somebody was willing only want this versus that. That's fine, but people want to have incentive to do this because sometimes they can charge a markup or premium, right, for that service. But in any case, there's a market for just US Treasury strips or zero coupon bonds, and therefore you can just use the strip price, right, to back out the risk-free rate, the interest rate that's used for the term structure, right? So that's kind of important in this case. You need to derive the term structure so that you can properly price a restructured debt product, discount all those new cash flows back to time zero, right? That's the objective here. All right, so let me give you a brief background of the case. So this case, again, the case takes place in the 1980s. You're a bank. You're trying to help Mexico restructure because they're going to default on their government-issued bonds because they decided to issue bonds in the U.S. in U.S. dollars. Why did they do that? Well, during the 1980s, there was an oil price, increase over time, meaning that the dollar was weak, and oil-rich countries such as Saudi Arabia and Mexico could sell their oil for a lot of money, right? And a weaker currency, U.S. currency, is great because they can just buy U.S. dollars on the cheap, especially if there's high inflation, right? And so in 1980s or beforehand, U.S. inflation was very, very rampant. I think there's over 10% inflation rate. And the dollar was extremely weak. So as you can imagine, all these oil-rich countries have incentives to issue bonds denominated in U.S. dollars because it's easy to service, right? It's easy to, you can use your own pesos to pay for cheap dollars and then service your bonds quite easily, no problem. And it's a good idea also because, again, oil prices are quoted in U.S. dollars, right? So if oil prices rise, U.S. dollars weak currency is great. Your pesos can buy more dollars than before, especially if it gets weaker. However, in 1986, there was an oil shock. Oil shock not in the sense of an increase, but a decrease. And the reason why there was an oil shock is because the Federal Reserve decided to increase interest rates dramatically. The dollar strengthened by a lot, and this led to the collapse of the near collapse of the Mexican economy. And again, the idea here, the problem arises because lower oil prices means stronger dollar, meaning that it's more expensive to buy dollars with pesos now. And now they're running out of money to pay to service their debt. And so your job is to help the Mexican government restructure the debt, swap out the old contract that's denominated in US dollars for something else that's collateralized with US treasuries. Right? That's the big picture idea. All right. Questions about the context? So hopefully you understand why there's the source of risk here, right? Your liabilities are in a foreign currency. That's bad, and the liability value has exploded because liability value I mean, the dollar has increased dramatically. Big problem. Now your job is to try to eliminate that exposure somehow. All right, so here are the hints. So part A, you're required to estimate, your job is to estimate the term structure. So part A, okay. So part A is a reminder that whenever you calculate the present value, in this case study, you're calculating in terms of per unit currency. So calculate the present value of your sequence of cash flow, but assuming that the par value is equal to 1 USD. Okay. So that just makes your life easier. You don't need to assume how much par to take on, right? You're going to back that out later. I mean, it's not even relevant, okay? Unnecessary. So just calculate the present value of the new contract as per unit of US dollar. All right. The second hint is that in your construction of your term structure, please just linearly interpolate. So meaning that you take the zero coupon bonds, right? You take the discount bonds, you plot it in Excel or whatever. So here's interest rates of the zero coupon yield interest rate, and you have yield, so years to maturity, right? Years to maturity on the x-axis, and you should have something like this, right? So of course, these points could be the discount rate because we're talking about T-bills, 6-month interest rates. Could be the T-bills that's expiring very soon, like a few months. And these could be zero coupon bonds coming from strips or whatever. There are quotes in the case, you need to find it. So it's like a treasure hunt. These are your typical MBA style case studies. You need to find the information and try to use the information to answer the questions. All right, so once you have these interest rates, you derive it from zero coupon bonds, derive it from discount rates, whatever. You then connect the dots, right? So meaning that you just have to draw straight lines between points. Why are we doing this? Well, because the restructured debt will be issuing 6-month interest payments. So you need interest rates to discount these coupon payments every 6 months. How do you interpolate? Simply just use the point slope form, right, from your high school math. That's my suggestion. Right? So X would be years to maturity, Y would be your interest rate or the discount rate, and therefore you solve for M, and once you have M, right, you can increment every 6 months. No problem, right? So let me write, in case you don't know what I just said, I'll type it out, and then you can point slope form. Right, so you just need 2 points. Y1, Y1, Y2, and sorry, Y1, X1, or I think it's the X first, right? And X2, Y2, right? Just pick 2 points, right? Years to mat, yield, and years to mat, yield, take the difference, calculate the slope between these 2 points, use the slope to find, derive, every 6-month increments and use those discount rates to discount 6-month coupon payments. Okay, so that's the hint to construct a term structure. All right. Part C will ask you to calculate no default value of the coupon annuity. So no default just means assume there's no cessation of interest payments until maturity. Just assume that, don't even consider default risk, right? Just assume that the coupon payments will keep going until the end of the maturity, including the final payment. So just assume there's no bankruptcy. And lastly, part D will ask you to calculate a ratio. And to do that, you just take the par value of the previous debt divided by the par value of the new bond. So you'll be asked to calculate both of these in the case study. So I won't go over that. I see this one. I mean, not par value. You'll be asked to calculate the present value of both of these contracts. That's previous part. So once you have the present value, just know that when you calculate the present value, it will always be in terms of per US dollar. To get the par value, you just take the inverse, right? 1 over PV will give you the par value, right? Per unit par, sorry, per unit. Yeah, so here is per US dollar par to get the par amount. per price is just 1 over PV. So 1 over PV over 1 over PV should give you the ratio. So this will give you par, right? And this will give you par per price, per unit price. All right, I'm sure you'll have more questions for me later, so I'll just leave it here. I don't want to give away too much, but I think these hints are pretty much super, I think, fairly clear. Will make the case reading super smooth. So there's, of course, several pages, but that's the nature of case studies, MBA style case studies. There's lots and lots of context, lots and lots of background, just to make the reading a little bit more rich and for you to absorb or put yourself in the context of these corporate finance people, right? They're creating new stuff, new securities, and trying to swap out these securities for old ones. Okay, that's the idea. All right. So I'll leave it at that. Just don't be afraid to ask questions from now until the last week of class. All right. So our task today is to revisit a topic of forwards and futures first. Okay. So currency, we actually already know, right? We already know this from week 2 or so, right? Through CIP, right? When you engage in the forward contract, you're doing this so that you eliminate future risk, depending on whether it's a delivery or receiving of foreign currencies, you engage in a long short position, right? So today I'm going to try to generalize this in the sense that I'm now allowing you to unwind your position before the end of your investment horizon or maturity. Okay, so I'm going to relax the assumption that you have to engage in the forward contract until end of delivery. That's not necessary at all from a risk management perspective. In fact, sometimes you don't even want the actual delivery of the asset. You just want to make the bet, side bet as a hedge, and then unwind before delivery. So that's the idea here. I'm going to try to make a distinction before forwards and futures. Of course, you probably already know the difference. The difference here, I'll talk about it again. I'll give you an example, but the difference here is that forward contracts are over the counter, meaning that you have to find a counterparty yourself, whereas futures, there's a centralized platform. You have a market maker helping you identify counterparties, and therefore it's anonymous. You don't have to go out and look for these people. That's the only difference. Other differences would be like having to pledge collateral, and just in case your counterparty decides to flee or run away. Okay. All right, so let's go ahead and talk about forward contracts. So forwards and futures contracts doesn't have to involve currencies necessarily. It can be the delivery of literally anything: a stock, a bond, cows, cattle, wheat, oranges, gold, literally anything. So commodities is a big market, and a lot of people speculate in this space all the time. So if you're doing ESG stuff, this is what people pay attention to. Weather forecasts can be derived from commodity trading, right? People believe prices are going to rise for oranges if there's like a very cold, chill winter, right? For a specific year, you'll see that, and you see if you believe crops will be destroyed, you'll see that information captured in the futures market, right? For oranges, for wheat, or whatever. All right, so futures market has a lot of information that you can extract from depending on what you want to hedge against. So I gave you an example with weather. There's other things like oil, of course, right? Commodities. If you believe oil is going to be impacted by certain wars, this is what futures contracts are for. You can hedge, right? Okay, so more than just currencies, right? More than just financial assets, then now you have things that are correlated with geopolitics that can also be important to you from a risk management perspective. All right, so it's important to emphasize now, just like what we did in week 2, you realize that once you engage in a foreign contract, nothing actually is exchanged at time zero, right? So, of course, this makes sense because both sides have to agree in order for the contract to be initiated, right? So that means that on average, the delivery and the purchase and the delivery returns are the same. At least both parties agree. And so nothing is exchanged at time zero. The exchange only takes place sometime in the future, for example, 1 year. So the fixed price that's set today, the future price, is a gamble, right? It's a bet, it's a wager. So naturally, uh, right, if you're long, you want it to be delivered at a specific price, and you hope to turn around and flip it, right, immediately in at maturity. So if you pay F, you're hoping that the spot price will increase beyond F, higher than F, so that you can make a potential profit. So E minus F is your return on so-called return on the long position. And that's vice versa for the short position, right? You're hoping that the price falls so that once you're hoping that you can buy cheap in the market, right, in the future, and then deliver that cheaply at maturity, at the expiration date. So, right. So today, no money exchanged, no goods delivered. Both parties agree that their value, they believe that both sides will yield equivalent on average the same return, whether you deliver it or you don't deliver it. It doesn't matter, right? It's still worth the same. After at settlement, in this case next year, seller receives future price and delivers the commodity. So this is what the seller is betting. It is hoping that this price is greater than zero, right? They're selling it at this price, and they're hoping they can buy it cheap, right? Buy cheap. Hence the minus, right? This is the short or sell side. Okay, I'll write a short here, short. The buyer, on the other hand, is betting that this is true. So let me write a big T here to indicate that it's the settlement date, right? He's hoping that the settlement date price of the underlying asset exceeds the future price, right? Because it's paying for, right? It's buying cheap from the seller, and hopefully it can sell expensive on the open market, right? So this is selling from the forward contract. This is selling on the open market. That's the difference. So this is long. So I'm introducing new ways of thinking, right? So it's no longer just hedging specifically. Now it's thinking about positions as returns, right? A difference. There's a difference now, right? F minus E, E minus F, depending on which side you take. So in practice, most transactions don't actually result, most engagement in forward contracts don't actually result in delivery of the underlying asset. These positions are often reversed or unwound before settlement date. All right, so I'm going to give you an example to show you what I mean by reversal or unwinding a position in terms of forward contracts. All right, so take, for example, a delivery of for just a dollar. So let's say uh, underlying asset is $1, and assume that settlement in 30 days, and but I want to close my position, meaning I don't actually want to make the delivery before settlement. So these are the steps I'm going to take to ensure that I don't actually have to receive or deliver anything. I'm gonna promise to buy $1 in 30 days. Let's just say using Hong Kong dollars, okay, in 30 days at T equals 0. And I promise to pay for it using a future price, but I'm gonna denote it as F underscore 30 to indicate that this is the future price that is to be paid at settlement 30 days from now. So F underscore 30. Okay. Step 2, I'm going to close my position at 29 days because I don't actually want delivery. I just want to make the bet, right? I just want to make the bet that the price of US dollars increase, right? Because I want the payoff of, in this case, ET minus F, right? So at T equals 29, I will promise to sell 1 USD in 1 day for F underscore 1. So F30 and F1 have the same settlement date. So let's say 30 days from now, let's assume it's May 2nd, right? Let's assume that's May 2nd. So this F30 and F1 both have the same settlement date on May 2nd, but I'm only going to do step 2 when it's May 1st, right? So the difference here is that in the first part, I promised to buy. So this is a long position, long forward. In this part, I'm promised to sell. So it's short. So I take the opposite leg and you'll see that I will no longer have to deliver or receive anything at all. Right. So what does my payoff look like at time 30? Let's just write it out. T equals 30. So we have from step 1 plus 1 USD. And I will pay for it F30 HKD. That's my first contract. The second contract, I will short dollars, which means I will promise to deliver $1 to somebody. And then I will receive F1 HKD. So the total inflow outflow is therefore 0 USD. So I don't even touch dollars, but I will get a payment, or I have to pay F1 minus F30 HKD. So depending if this is positive or negative, I either pay money to my counterparty or I just I receive money from my counterparty. So if you reverse this with your counterparty, right, then it doesn't matter anymore, right? So if you find a counterparty who's just trying to make a bet that's the opposite of yours, then there are no exchange of foreign currency, right? It's just a bet, right? It's a bet on top of the underlying security. That makes sense. So because I'm long in the beginning, I'm betting that the underlying price of the future price will increase over time, right? If it increases over time, then this value will be positive, which means that my bet was correct, right? Hence the long position in the beginning. But of course, it can go the opposite, right? So if it's positive, that means that future or spot price increase over time, i.e. long position, right? But the opposite direction, future spot price decrease over time. Short position wins. Okay, I'll write wins, so it makes it clear. Right? So end of the day, futures is just a side bet, right? It's just a side, it's just a bet on top of the security. If you do this unwinding, right? If you do this unwinding. Right, so settlement can be done in cash and just transfer F minus F1 minus F30 to long or short position, depending if it is positive or negative. Right. So you have a general idea that you have a general understanding now of unwinding. Okay, so this is like an extra feature to think about when deciding how many contracts to buy, right? To hedge your position, because you have this option to unwind now, right? If you want, you don't have to hold anything to maturity. You can now decide how much to hold conditional on unwinding. Now, the difference between forwards and futures is that futures are exchange traded, and the value of your position is marked to market every day. So that means that if the future price changes over time, whichever side is winning, like whichever side is winning in the sense that the price is moving in the direction that helps them, makes them more money, then that money is transferred to the winner from their collateral. All right. So let me give an example. So suppose we have a futures contract for euros. The contract size is 125,000 euros. And the future price is listed in the second column here as a starting point. So time zero, we have a future price of 1.3321. This is the contract size. And let's assume that we are taking the long position, meaning that we're hoping that the value of euros in terms of dollars increases over time. So let me write that. You are betting that euro is going to get more expensive in terms of US dollar at settlement. All right, so how does mark to market work? You check the future price every day. So at T+1, the future price increase or decreased. So a decrease means it works against you, right? So this decrease is 0.0006. So minus 0.006 times this number will give you this number here. Okay. Right. So we're multiplying the price change, which is in terms of dollars, and that's a minus $75. Cumulative just means we sum up all from the beginning all the way to here. And because it's a negative, you deduct $75 from your collateral, which is your margin, 2,000. So that's why it's here, 1925, right? Because 75 plus 1925 is 2,000. So you keep doing this every day. At T+2, it further decreases. So it's another decrease of 0.0011. This number multiplied by 125,000 gives you the amount of loss in terms of dollars. That's $137. That number can be deducted from 1295, and so the margin account is deducted further to 1787. And just know that these losses gains, losses are transferred to counterparty. Okay. Makes sense? So if you're winning, you get money from your counterparty. If you're losing, money's deducted from your margin account. Typically, there is a threshold in which if there's a large decrease that's large enough, there will be a trigger in which you must recapitalize your collateral or your margin. So up to T4, the scenario is that if there is a fall by more than $500 it will trigger you to recapitalize your margin back to 2000. So as you can see at T plus 4, further decrease, right? Even worse for you. And the cumulative loss now exceeds 500, which means that you have to recapitalize your margin. So this is right here. That's why it's a 2000 again. But after T plus 4, it looks like the price is now moving back up again, right? So here we have 3264 to 329 back to 33. These are plus plus. Plus plus means that your counterparty now is transferring money to you. So that's why you see a plus 2000 to 2400 to 2462, etc. All right, so that's what mark to market futures market looks like. That's what your account looks like day to day. Comments, questions on the difference between futures and forwards? What does mark to market look like? What is collateral? Why you need collateral? Again, collateral is to prevent your counterparty from fleeing, and at the very least, you recover some if they do flee. At the very least, you get whatever's in their margin account. Um, yeah. All right. So let's talk about hedging with futures. So I'm going to introduce some new notation. Again, this is all review for those of you who had derivatives, so just bear with me. But for those of you with no background, I need to introduce some new notation for hedging futures contracts. All right, so hedging just means that you want to protect yourself from a direction of the price change that hurts you. All right, so it depends on if your position either is an asset or a liability position, right? An asset position just means that you're hoping the price goes up because you want to sell the preliminary the pre-hedged portfolio sometime in the future, right? So the raw portfolio without any hedge, I'm hoping that the value increases, and you want to protect yourself from a price decrease if you're an asset position. Conversely, if you're a liability, you have a liability, that means that you are hoping the price falls, right? But a price increase could hurt you, and so you want to protect yourself from a price increase. So let's start with an asset position. An asset position here, let me write it. Asset position. Betting that underlying asset increases in value, exposed to downside, exposed to decrease. Decrease in asset value, decrease in price hurts, decreases asset value. Okay. Decreases position value. Okay. All right, so maybe sometimes it's called long, right? Long position. All right, so let's draw the graph. I'm going to use graphs now, but of course there'll be math. So let's start with the following graph. I'm going to note the graph that we have an initial price, the purchase price of the asset at E naught. So let's assume that we bought something, bought an asset, foreign currency, for example, at E naught, and we want to sell it in the future. And so relative to the original price, I can either have a gain or a loss, right? In this case, since we're going long on the asset, I'm hoping that E1, the next period's, one period later's underlying price is greater than E naught. If it is, then my payoff function, which I'll write as G, as a function of the future price, is equal to E1 minus E naught, right? Because that's what I'm hoping for, a positive number, right? But of course, if E1 falls below E naught, I lose money. That's my gamble. That's my bet. So if I were to plot this, this means that I have an intercept term here at 0, right? And then anything above, anything to the right of E naught will be a positive number. Scale linearly. And my losses are also linear, but in the opposite direction. So you can see below 0, negative, above 0, positive, right? So this is my unhedged position. Because I have no futures contract, I'm just holding on to some asset that can increase or decrease in value. Now, I'm going to hedge it, of course. And to think about how to do it, I can just visually look at this graph. So I want protection from here. So I need something that cancels it out, perhaps in this quadrant here, right? And so my hedging position will most likely be gaining profits when E1 goes below E naught, right? And so my hedging position will have the following payoff. So I'm going to write F for futures, and it's going to be a function of also E1, but my payoff is going to look like F minus E1, where the origin is F, of course, 0 payoff, and relative to where E1 lands after one period to F will dictate whether I get a positive return on this contract or negative, right? So here, if E1 is super small, right, I should get a positive payoff. Agree? So small e, the smaller it is, the more I benefit from this position. So this is short forward. So I write short here. Right? This is exactly what we wanted, right? We want protection from this downside risk in which E1 falls below E naught. This can be eliminated with a forward contract that pays off something when the asset price falls. But of course, I can lose money from this position if E1 exceeds F, right? So there. So based on these plots, you can already tell what the final hedge position should look like. This upward sloping, downward sloping, so negative, positive should cancel each other out. Positive, negative should cancel each other out. So my payoff, therefore, will be fixed, right? So I have to give up everything, upside and downside, to when I use futures contracts. So this unhedged position plus the hedging instrument will give me the final hedged position, which looks like this. So this is G E1 plus F E1, which is equal to E1 minus E naught plus F minus E1. E1 goes away, right? And so my payoff is just F minus E1, some constant. And so this is E1. The line could be up here or down here. I don't know, because this could be positive or negative, right? So this one could be here. If it's greater than 0, could be here. If it's negative, right? But my payoff does not depend, does not depend on E1. Just like in week 2, right? When you engage in a forward contract, when you're trying to arbitrage interest rates by borrowing low and lending high, when you engage in a future forward contract, you're eliminating all exposure to E1. So it's a fairly blunt tool, right? You can't really pinpoint, you can't wager anything along this price range, right? You're just saying, well, if I do this, then I have to basically eliminate upside and downside. So the way to view this hedge is that, well, I give up upside, but I have a guaranteed positive payment, so that's great, right? You're exchanging risk for some guarantee. Otherwise, this is like you can interpret this negative as in, well, I'm protecting myself against large losses, right? I'm willing to pay an insurance premium. So both of these is possible, right? A positive or negative one. One gives up upside, one downside protection. So both possible. In other words, I'm saying it's not an arbitrage here, okay? You have to give something up to get something here. Here is, again, if it's positive, you're trading upside for guarantee. This suggests that you're paying an insurance premium for large losses. So there is an exchange or something. It's not free money here. All right. For a liability, so liability is different from an asset position because you are short something and you hope asset decreases in value so that you can buy back cheaper or repay your loans cheaper, right? So what does a short or a liability position look like graphically? So our G function will now look like this. You are hoping that you can buy back cheaper, so E naught minus E1, or small E1, that's to the left of this origin. So it will be a downward sloping curve here, right? And then if E1 is greater than E naught, you will have negative payoff, right? So this is again the unhedged position, the raw position. So what do you need protection? You need protection here, right? So this is positive, it's negative, you want protection here. So you need a forward contract position that gives you that positive payoff to the right of E naught, right, for your protection. So we take the opposite position compared to the previous slide, in which now F is making money when E1 exceeds, sorry, when F exceeds or is below E1. So here we have E1 minus F, right? You're hoping E1 is greater than F. So this is I wrote short, so this is long. Yes. It's long because you're betting that the underlying asset beats the future price that you fixed at time zero. Right. And so our reference point is F, x-axis is E1, y-axis is payoff. If E1 is greater than F, we have a positive payoff. And of course, there's downside for futures positions. This negative cancels out this positive, this negative cancels out with this positive, and so the overall hedged position will look like just like here, a fixed payment, right? So that's hopefully you see what's the mechanism here, right? You're giving up upside and downside for fixed cost or capped payment. So your G E1 plus F E1 is going to equal E naught minus E1 plus E1 minus F. And so it's just equal to E naught minus F. Of course, it can be above or below. It's greater than 0 if it's here, otherwise it's less than 0 here. And that's okay because you're trading off different things, right? Here, you're bounding your payout, your future upside. Here, you're paying for premium, I mean, for an insurance premium. Okay, so to summarize, hedging, depending on your position, you have the following table. If you have an asset, you're hoping the underlying asset increases in value so you can sell it for a higher price. You should sell forward, but the trade-off is you're giving up upside, right? And you're trying to protect yourself from any drop in value. If you have a liability, you're hoping that the underlying asset falls and you want protection from any increase in value. You can buy long forward, but again, you have to give up all upside. So it's from a risk management perspective, this is quite blunt, but in any case, this is something you can do. And then you'll be either paying for a premium or trading upside for a fixed payment, right? Comments, questions on the nature of futures, forwards, contracts, how to use it to hedge, given your position. All right, so we're just determining the key takeaway, of course, is assets sell forward, liabilities buy. Okay, liabilities buy, assets sell. Now the question is how much, how much, or how many contracts, right? That's question one. And what kind of contracts? If you cannot find the same underlying, can you substitute using some other futures contracts? What else? What types, right? And we're gonna answer this now. All right, so before I give you the new objective function that tells you how much to hedge and what to think about when looking at futures contracts, I need to create new variables, define new variables to make the math easier to read. Okay, so first things first, I'm going to define something called the basis. So the basis is simply F minus E. Okay, so this looks familiar, right? When you look at UICIP, it was F minus E over E, like the forward premium, but we have a different name here. It's just called the basis. We're not done yet. So with the basis, we can now define something called the basis return. So I'm going to use RBT. So T is just a given specific time index. RBT is equal to BT minus BT minus 1. Now, this is going to be strange. Rather than divide by BT minus 1, I'm going to be dividing by ET minus 1. So it's not a real return in any sense, but I'm just going to call it the basis return. All right, so just remember this. This is, I put a star here, right? The basis return is scaled by E, not by B. All right, for returns on the underlying asset, it's simple, right? It's just the current price minus previous price divided by previous price, so percentage returns. For futures return, I'm going to define something called a pseudo futures return. It's called pseudo because, again, I'm not scaling by FT minus 1. It's FT minus FT minus 1 divided by ET minus 1. Okay, again, I put a star here. So you know that it's a pseudo return. It's not it's not the actual return on the futures contract. It's divided by the underlying asset instead. All right, comments, questions on these new definitions. So we have this one, we have this one, well, primarily these two, okay? This one and this one, right? This is not the forward premium, right? Right, this is something else. Just know that it's this and this. And basis return is the same time, right? The time interval is the same. But when I define the basis return, it's the difference between BT and BT minus 1. All right, so objective 1 is to determine how many contracts to buy, right? How many contracts to buy. So I'm going to give it, of course, given that you can unwind. Okay. So suppose we plan to unwind before settlement and it's only one period. Okay. And let's just suppose that we have a asset position. So assume we have an asset position. So an asset position just means that we are planning to liquidate our original asset at some time in the future, in this case at time t. So suppose we're going to liquidate n units of some currency and we're going to multiply it by the price. So E times T, ET times N is the value of the asset or the currency you're selling at time T. Okay, so is that clear? Now you're given the choice to hedge. So that means that we're going to, since we have an asset, we're going to short, right? Short means that we're going to receive F sometime, but we're going to unwind in the next period at time T, right? Because that's where we're going to liquidate our entire portfolio. So what that means is that VT, our total value of our portfolio at time T in which we liquidate, will be ET times N, that's the selling of the underlying asset, plus FT minus 1 because we engaged in a short forward, so we're receiving F and delivering the underlying M units because we don't know how much to choose, we don't know how much to buy. And then we're going to unwind this position at time T. So we close our position. So when you unwind, you take the opposite position. So we were short, now we're long. When we are long, we're going to be pairing F. So it's minus FT. And again, it's M because we want to unwind completely. Taking out the minus M, we get this formula here. All right, so this is our starting point. This is our objective function, so to speak. Meaning that this is something we want to work with to either calculate its variance and try to minimize this portfolio value. All right, so to make it clear, I'm gonna switch to my other slides because I give you more precise way to reformulate that portfolio equation. So this is the same equation as I just explained. The total value of the portfolio is equal to liquidating your asset position minus the bet I made using futures contracts or forward contracts, right? You have a plus F minus 1 for short in the beginning, and then the minus FT for unwinding. Now the trick here to rewrite everything in terms of returns is to plus ET minus 1 times N and minus ET minus 1 times N. So plus ET minus N times ET minus 1 times N minus ET minus 1 times N. This is just 0, right? This is a trick you must have seen in your algebra class, a lot, right? So once you do this trick, we can group this minus ET minus 1 with ET. You kind of know where I'm going here now, right? ET minus 1 looks like I can define a return on the underlying asset now. So let's group ET minus ET minus 1 times N with ET times N. Factor out the N. That's this parentheses here. And everything else is the same. In this row, I am factoring out N. right? So I take out n. So now h is defined as m divided by n. So this is the hedging ratio, right? So this will tell you how much relative to my original position to buy, right? In order to hedge. Okay, so that's where the h comes in. H is factoring out n, so h is now redefined as m over n. All right, the last step, I am dividing everything by ET minus 1. Okay, so ET minus 1 divided by ET minus 1 is just the raw return of the underlying asset. And then FT minus 1 divided by ET minus 1 is the pseudo future return. Again, pseudo because we're scaling by the previous period's spot rate, not the future spot rate, right? The previous future exchange rate. So now you can see that our objective function is written in returns and it's very simple and it's linear, which means that if we focus on minimizing, so if we decide to minimize the return variance, this equation is all we have to work with, because when you take the variance of a constant plus something, the constant is not relevant anymore. You can throw it away. And also the n is not relevant either. It's a constant. So given this variance, this difference, we can easily expand this based on the definition of the variance of linear combinations of expressions, right? Because that's just the variance of each component. If it's a constant, you square it, and then you minus out 2 times the covariance of the raw return and the pseudo return, futures return. So again, check your definition. This is the definition. Definition of variance. Okay. So solving for this is easy if you know just very basic calculus. So all you have to do is take this expression, take the derivative of it with respect to h. This is called first order conditions, and set it equal to 0, and then solve for h. Why will this be a maximum or minimum is what you're asking? Well, if you were to plot this, it will look something like this, right? It will look like something like that. So if you plot this, with respect to h, it will look like that. And basically what you're doing is you're setting the slope equal to 0, right? And you're just solving for the h that gives you the, sorry, it's a minimum. It's the opposite. It's this way. Okay. And this is h, right? This minimum. So we're solving for the slope in which equal to 0. Solve for h. I'll leave the math to you, but you can pretty much see it already. This goes away. This is 2h. The 2 cancels out with this 2. And so all you're left with when you put everything on one side and keep h on one side, you should get this following expression. All right, so this may seem complicated to calculate, but I assure you this is something you've definitely seen in your statistics class, right? This is just the regression coefficient when you run this equation, when you estimate the following model, right? So if you regress the raw return of the underlying asset using only the future pseudo return as the dependent variable with a constant, estimating this regression, the estimated h is your h star, right? So it's very easy to get if you have historical data. Comments, questions so far? All right, so maybe I recap a little bit and then so we started out with a new objective function, right? It's no longer just graphs, right? We're not just working with graphs anymore. Now we're thinking about the possibility of unwinding, and if we can unwind early, how much futures or forward contracts should I buy relative to my current position? So whether you're short, having a liability or an asset position, the math is, almost very, I mean, it's just the opposite direction. But in this example, I started out with an asset position, meaning that I'm planning to liquidate my raw asset in one period later. So N units times the price is the total value of my portfolio when I liquidate. But I have the choice to hedge in the previous period. Given an asset position, what I should engage in is a short forward. So that's plus FT minus 1, right? Because I'm a short forward means I'm receiving some price and then delivering the underlying. When I unwind at time T, I will take the opposite position. I will pay FT for delivery, right? But because of my previous contract, I basically don't have to move anything, right? I don't have to deliver or receive anything. I just pay the difference of FT minus 1 minus T, or in this case, when you factor out minus M, it's FT minus FT minus 1. So you see that minus, this is the cost, right, of hedging. The cost of hedging. So hopefully you kind of see that intuitively. I'm being agnostic about how much to hedge, so I have to have a placeholder variable for M, right? This is the number of contracts I need to buy relative to the amount of assets I have in my portfolio so that I minimize my return variance. So the steps from here to here, all I'm doing is rewriting my objective functions in terms of a return. That is done through plus minus ET minus 1 times N, and then grouping everything together, and then dividing everything by ET minus 1, such that my return on my hedged portfolio is simply the difference in the underlying asset return minus H times the pseudo forward return, of course, with other constants, which becomes irrelevant because my objective is to minimize return variance. So the variance of a constant, something plus a constant, the constant is irrelevant. And the constant that's multiplicative is just factored out, again, becomes irrelevant because I'm choosing a parameter that minimizes the entire expression. So I can just focus on the difference of RET minus H times RFT. This variance of an expression of a linear combination is easy because the linear of a combination is simply the variance of each component minus 2 times the covariance, taking into account of the constants, of course. This expression is quadratic, right? Quadratic means that there is a global minimum or maximum, but in this case, it's a minimum. So you can minimize this by taking first order conditions. I'll write f dot o dot c. That just means takes the first derivative and setting it equal to 0 since we're choosing h, right? This is our choice parameter. So we want to find the optimal h that minimizes our portfolio. First order conditions. The solution looks like this. It should be fairly clear because when you take the derivative with respect to h plus, it becomes 2h, and the 2h's go away, moving everything to one side. Look at something very simple, and if, again, this expression is exactly a beta coefficient in your regression. So run this regression, solve for or estimate h hat, that's your h star, and you're done, okay, from a risk management perspective. So of course the choice is what's your historical data you should use to estimate h hat. That's up to you. All right, so that's easy, right? So far I think it should be easy, but now the problem becomes what if your futures contract is not exactly referring to the same underlying in your asset position? So maybe you have like an exotic currency and there are no futures or forward contracts that you can buy or sell in the open market that has exactly that exotic currency in your portfolio. that's okay, right? Because based on this portfolio equation, it's very generalized, right? So the question now is, if you have a spectrum of futures contracts with different varying currencies that you can use to hedge, futures or forward contracts, which ones should you choose? What are the characteristics that define a forward or futures contract that's ideal for hedging? And you can see that by substituting H star back into this equation here, right? Into here, right? Into H2 and H2 here, 2H here. So plug in H star into here and here, and then do some algebra. Okay, so I'll leave that as an exercise. So I wrote here, substitute H star into the variance of this expression, which is this expression here, right? This entire expression. You should get something that looks like this. I leave it as an exercise. Derivation left as an exercise. Again, it's not important because it's just tedious algebra, but for those of you who are wants to be rigorous, you can go ahead and do that. Derive it yourself. Okay. What does this tell us? Well, this tells us there's really only two parts of this equation that helps us choose the futures forward contracts to think about. The first one is the variance of the basis return, right? And the other is 1 minus the correlation coefficient squared of the basis return and the underlying asset return. So remember what the basis return is, right? This is it. And so what you are supposed to think about is, where can I find a return in which the variance is very close to zero, right? Because a zero numerator would mean that the entire variance goes to zero, very close to zero, right? So maybe I can find a variance of the basis return that's very close to zero. Or I can find a futures contract in which the correlation coefficient between the basis return and the underlying asset return squared is close to 1, right? Because 1 minus 1 is 0. I hope you see that, right? This could be close to 0, or this could be close to 0. These things you can't touch, right? This is just what it is. And same thing here. It is what it is, right? You can't move this. I guess you can make it bigger, but that's not something we can really think about. All right. So if the basis has 0 volatility, right, you can get a perfect hedge, go to 0. Or the basis is perfectly correlated with the spot price, in which the correlation coefficient is almost 1. So just based on, if you look at the data itself, you can see that this is impossible. Okay, you can never see this in reality. And so your best bet for hedging is to identify a futures contract in which the basis return variance is as low as possible. So you most likely will get an imperfect hedge, right? But something that's close to zero, as close to zero as possible, is your best bet or your best choice. Comments, questions? So the recap is, after understanding how to identify the amount of contracts to buy or use to hedge, that's H star, we now have to think about, are there different types of futures and forward contracts that I can use to hedge if I can't find the ideal one? If that's the case, then I can plug in H star back to the variance objective function that I'm trying to minimize and plug in the ideal equation here for H star. I now conclude that I should look for forward and futures contracts in which there are two features that could help me. One is that the variance of the basis return is close to 0, or the correlation coefficient between the basis return and the underlying asset is close to 1. So empirically, of course, as you can imagine, this is probably not going to work. You can check yourself, but this offhand, there's very little reason why these two things should be close to perfectly correlated. Well, your best bet, therefore, is to choose a futures or forward contract such that the basis return variance is very low. So low volatility basis return is what you're looking for, or what you should look for. All right, let's move back to right. So this is left as an exercise. It's quite tedious, but anyways, not important. So my takeaway here is that, right, there are two conditions to think about. The basis has zero volatility or the basis is perfectly correlated to the spot price. And as you can imagine, there seems to be very little correlation between basis return and the underlying cash return, right, in reality. And so your best bet, therefore, is low volatility basis. All right, so before we take a break, let me now go back to something you're all familiar with. We're going to talk about the future spot parity, which you may have seen in your derivatives class. If not, let me tell you the equation to price futures contracts in general. All right, so let me just show you the equation here. So we're going back to, let's see, all right, here. So this is the so-called cost of carry model or the future spot parity that you see in your textbooks or your other financial derivatives class. And it's something that you should remind you, of course, of the CIP a little bit, right? And the reason why it may be different is because everything is expressed as continuous compounding, which is why you see this exponential function. But just know the exponential function is analogous to 1 plus of return, right? So these variables here in the exponential can be interpreted as returns, but continuously compounded. So let me explain to you intuitively what this formula is saying. This is saying that the future price of a underlying asset, stock, bond, currency, or commodity, is equal to inflating or deflating the exchange rate, the underlying asset, depending on the costs and benefits. So the cost of delivering the underlying asset, E, is R and S. S stands for storage cost. So let me explain. Anything that's going to cost more to do, you're going to transfer those costs to the counterparty. So in this case, take your position as the short position. Your job is to deliver the underlying asset. If the cost of delivering is going to be incurred on by you, such as storing gold in a warehouse, buying insurance for the gold, or the borrowing cost increase to buy the gold, then you should transfer those costs to your counterparty. So a positive exponent means that we are inflating E, right? So E times ET, exponential, some positive number, is going to increase E, right? Because a negative exponent is 1 over that, right? So R stands for cost of borrowing. Higher cost of borrowing will inflate E. Higher storage cost, because from the short position, you're going to incur those expenses to preserve the quality or whatever of the underlying asset. You're going to transfer those costs at delivery time as well. So all these things will inflate E. However, if there is a benefit to holding on to the asset, such as dividend payments, interest payments from bonds, dividend payments from stocks, foreign currency interest payments on foreign currency, these things will not be paid by the counterparty. They don't want it, right? They're not paying for cash emissions that have taken place before delivery. And those emissions, of course, will come out from the actual price. And so these benefits will deflate E. because the counterparty will not be paying for it. The counterparty only wants delivery of the asset, not anything that comes out of it beforehand. Okay, that's the intuition. Make sense? So to prove this general equation is straightforward and is pretty much mirrors the proof for CIP, but let me walk you through the proof. So to prove this, we use what's called the cash and carry explanation. So this is what you do. So suppose the underlying sake, just for the sake of demonstration, is a domestic bond that we're supposed to deliver in 1 year. So what you do is you sell forward, meaning that you're going to create cash inflow sometime in the future, and you're going to receive F. Okay, so this is called the cashing. At the same time, you're going to borrow E, so you will owe money plus the principal, interest plus principal in 1 year, and you're going to use that amount to buy a bond. So you have to carry the bond to delivery. This is a financial asset, right? Which means there will be benefits from holding onto this bond because there could be interest payments, right? So there is a benefit. There is a so-called convenience, right, to holding onto this bond. All right, so let's look at the cash flows. For this combined position, you will have a liability of E plus E times R because you have to pay for interest payments, the cost of borrowing, plus the principal that you borrowed, ET. For cash inflow, the proceeds, you will get the F because that's what you engaged in to create the cashing, plus any coupon payments that incurs. So coupon payment times the principal, right? That's E times ET. So there's a benefit and there's a cost. So you can kind of already see what's going on here. Total profit is total proceeds minus total outlay. So in equilibrium, the profit must be equal to zero. Otherwise, there's going to be arbitrage, right? So if you rewrite everything to look like this, in which F is on one side and E and everything else is on the other side, you will get something that looks like that equation, right? So you have F equals E times the return, 1 plus R minus C. Increasing the borrowing cost will inflate E. Increasing the convenience of the coupon payments will deflate C. Right, so just like this equation here. Now the relationship between this proof and the proof you saw in week 2 or 3 is different in the sense that I'm creating a different caching from the get-go. So suppose now the underlying asset that I'm going to deliver is 1 plus R star unit of foreign currency. So I'm going to sell forward 1 plus R star times F. This is the caching. Still borrowing E, and therefore paying E plus E times R still, right? This is interest plus principal. And then I'm going to take that E and deposit in somewhere. So convert the unit of currency and purchase a unit of foreign currency and deposit it somewhere so I earn interest. So there's a benefit, right, from carrying the currency. So 1 plus R star times F. That's total proceeds. Calculate the profit, which is the following. It must be equal to 0. Let's rewrite it in such a way that looks like CIP. We can. It will look like this. Right? So this is CIP. Right? Just move this here and then move F over here. It's CIP. Right? So now I hope you see that whatever you learn in week 2, week 3 is exactly what you learn in your derivatives class, and really is no big difference. Okay. And the focus, of course, is that the generalized formula subsumes this borrowing cost slash benefit, convenience of holding on to the foreign currency or domestic currency. It doesn't matter which way you do it. Okay, so let me see what else I need to talk about. All right, so I talked about this already. And all right, so I'll talk about this after the break. So let's take a 10-minute break. If you have questions, you can ask me. Then after the break, I'll finish up futures, some futures terminology, and then start on options. All right. So I'll talk to you in a bit.
Yeah.
为什么就是我们要把这个，就是这个 hedge asset 这个是non hedge 情况的，然后这个是我们short forward 的收益 payoff 然后为什么我们最后要把它们就是加在一起
Because your job is to manage risk. And we're showing here that when you construct a portfolio of futures and an asset, you eliminate risk somehow.
因为就是这个难道不是已经对，就是已经 hedge 过的情况了吗？我们已经
No, this is just the instrument. So this is the hedging instrument. So if you just have this is a wager. It's not, you're not managing, you're making a bet. You're not hedging here. Hedging means that you have something, you have a position, pre-existing position, and you want to protect yourself from price movement. If you just have the asset, you're exposed to everything. If you just have the futures option, futures contract, you also are exposed to something. It's only when you combine the two where risk is eliminated. Yeah. So the context is you work at a company and let's say you're an airline company and you want to protect yourself against oil price increase. And your portfolio is your portfolio is basically like what ticket sales, right? And your cost of goods, revenue minus gross income minus cost of goods service, right? But your cost of goods could increase, right? Because your oil price could increase. So now the question is, what sort of instrument can you buy or sell to protect yourself from having your cost of goods increase, right? So the context, right?
把这两个加在一起，就是1万，就是会eliminate
Yeah.
掉
Yeah.
然后我可不可以这样子理解，就是因为我们本来就有这个资产，
Yeah.
如果是 short 这个只是 short 一个 forward 的话，我们这个收益它这样子计算 payoff 是因为我们本身没有这个资产，我们需要到spot market 去买这个资产，去
So in order, if you just have this contract, it doesn't mean anything unless you take advantage of the price difference between the future price and the spot price. So if you just want protection, it only makes sense if you have a pre-existing position to protect against. If you just have this contract, it doesn't mean anything unless you also compare F with the spot market.
就是所以可以理解成我们 short this forward，我们还是会面对风险，因为有可能就是如果 spot price 上升很多的话，我们只能用这个 forward price 去卖出这个资产，这样我们就会 我们就会有一个 negative payoff。但是我们现在本身我们已经有了，我们本身就是 long 这个 asset，所以我们这个时候就是我们进入when we enter into this short forward, we don't need to um we don't when delivery we don't need to buy this asset in the spot market to to deliver it to the counterparty. So so the risk is eliminated.
And relative to E naught. Here, the return on F is defined as relative to E1.
Oh.
So if you want to define a profit, whether or not you're correct in your prediction on F, right, you have to compare it with E1. For example, if you are long and you end up paying F more expensive than E1, then you lose. You made a dumb decision. And so to measure that bad decision, you have to compare F and E1, right?
So this is a gamble.
It's a gamble, yes. This is
is
also a
the-
gamble,
So, 我们可以
but they're gamble, but predicting in opposite directions. That's what hedging is. Hedging is going in the opposite direction.
这个我知道，但是我不知道为什么会有一个 negative。
Because I didn't give you values for F or E. It's possible F is smaller or E is smaller. I don't know which one is smaller.
If I'm an investor, I know the spot price, that I will not enter into a short forward that the forward price is smaller than
Why not?
zero. 因为我们已经知道这样会有 negative 的 payoff 的情况，为什么我们还要进入这个合约？
So in the future spot parity, it doesn't say F is less than E. It just says that there's a bunch of other stuff that you should consider. Cost, exponential cost minus DS, right? These things can inflate or deflate E, right? So it's not,
We can determine decide. F is affected
F
by
is
many-
greater or less than E naught.
It's not 就是这个东西是不确定的。
Yes. I mean, it is known. You know it at the get-go, but you know what you're getting yourself into. If it's negative, that means if it's negative, you think of it as insurance. You're paying for this premium, but you're protecting yourself against a loss. If it's positive, then you're basically giving up all the upside. And do you understand? So it's not a free lunch or irrational, right? It's yeah. It's not a free lunch and it's also not irrational.
这不是像一个 option 一样，因为我们进入 option 也需要支付 option premium。
Option in what sense? Sorry.
权
I know, but what are you trying to say here again?
这个是我们相当于我们要 protect the price change risk， 所以我们需要支付的 premium，
You mean the price of the call option? And the price of it. Yes, it's somewhat like that, yes, but it's not exactly the same. Because you pay the premium up front, here you pay the premium ex post,
Oh.
right? You don't know.
Mm.
Yeah. Okay. Yeah.
Well,
Oh, it's open. I mean, just like midterm. Yeah, like midterm. Yeah. Go over some definitions. And then that will be our conclusion for futures and fours. So if you look back on the future spot parity equation here, this entire set of interest rates, you can call it R minus D plus S minus C, has a name. It's called the cost of carry, right? Right. So when you read the news, sometimes you'll see the phrase positive carry, and you might see the phrase negative carry sometimes. So what is this referring to? Positive carry specifically means that F is less than E. So meaning that overall exponential ... is deflating E, right? It's low, there's a big convenience to holding on to the underlying asset, and therefore it has a positive carry. But it sounds exactly what it means, right? So there's a positive benefit for holding on to the underlying asset. Lots of dividend payments, or maybe gold. Gold has a convenience because it's very, very liquid to sell, etc. And therefore, F is less than E. Okay. On the other hand, the opposite, you get the the inequality flips, meaning that exponential ... is inflating E. So there's a lot of cost to hold on to the underlying asset. So things concerning physical commodities like cattle, like oranges, like coffee beans, etc., very expensive to storage, to pay for insurance, etc. Even delivery, you have to find a way to deliver it. That's going to be priced in to the futures contract. And so something in which F is greater than E just means it's very expensive to carry to settlement. Okay, so that's, again, just definitions. All right, the other phrase, the other phrases that you might encounter in your reading of newspapers is something called contango and normal backwardation. Again, it concerns the relationship between F and E, but the difference now is that we have this extra expectation function. So an average, right? So it looks like positive carry, negative carry, but it's not saying the same thing. So in general, we don't know what this looks like. And so when people say normal backwardation or contango, they are referring to the trajectory, the long-term evolution of the underlying asset and how the future price is approaching E. So let me draw you a picture. Usually this is what you'll see in Bloomberg or whatever. They will look at the underlying asset over time. E might, fluctuate like this, something like this. But F, so this is E, but F could approach from above, or F can approach from below. So I hope it's clear, right, that eventually at settlement, F has to be equal to E, right? That has to be true. But how it approaches E can be different depending on the underlying asset. So, well, let me give you the definitions. When F is less than the expected E, which could be this line here, this is called normal backwardation. Normal back. I just write BD, okay, backwardation, or BW. If the F is approaching, so these are Fs. If F is approaching from above, this is called contango. Normal backwardation is called normal. It's because if we expect something to have uncertainty or risk, that risk should be offset with a higher average return or average price level, right? And so F is something that's deterministic, right? It's a known quantity, it's a constant, doesn't change over time. So, or the one that you pay for today. So F is less than something that has risk, obviously, right? So this is considered normal. Whereas contango would be considered abnormal, right? But of course, if you look at uh, specific underlying assets such as commodities, then this is actually normal. So this is normal for commodities, though. And because cost of carry is very large, right? So if you want to just solve for rho, you get the same conclusion. So suppose you're able to rewrite expectations in this model, you solve for rho. If rho is greater than R, then it's normal backwardation. If it's less than R, it's in contango, right? So, right. So here I wrote, if there's systematic risk, contango is unusual and this is normal. But again, for commodities, what's going on is the cost of carry is going to inflate ET in the long run. And therefore, right, F is greater than E. Expected value of E, future E. All right. Comments, questions? So just notice the subtle differences between the definition of negative carry, positive carry versus normal backwardation versus contango. The difference is this expected value. That means it's model based. And again, if you want to have some way to model this, you can do it this way and solve for rho. And as long as rho is positive or negative, greater or less than the borrowing cost, will inform you whether or not you're in backwardation or contango. All right, that's it for currency options. Currency futures and forwards. If no other questions, I will move on to our discussion on options. All right, so options is fundamentally different from pricing everything you've priced so far. Stocks, bonds, futures contracts. It's fundamentally different because the payoff structure of options is nonlinear. Okay, so those of you who have some background already from previous classes, you probably already know this. But for those of you who are uninitiated, I'm going to give you a big picture explanation of options first. And then I'll talk about the contracts, how to use the contracts to hedge. And then next week, I'll talk about, again, big picture, hand wavy explanation of how to price options and why it's different. But big picture explanation first. Option contracts are also sometimes called contingent claims. It's contingent, meaning that it depends on some state in order to trigger a payoff. Unlike stocks, bonds, futures contract, right? There is no trigger, right? It is what it is. Whatever the price is today, there's a return, there's a price. You calculate the price today, price yesterday, there you get a return. In that sense, it's absolutely correct to use CAPM, or the capital asset pricing model, to price these securities. Okay, bonds, stocks, right? I think you learned this. CAPM is a general asset pricing model. It should be able to price everything. But options are fundamentally different, as I said earlier. It depends on the state of the world. Okay, in which case the payoff could be triggered depending on the prices above or below some threshold. And again, this is big picture. I will define the contract for you if you haven't seen it yet. But that's the idea. Because the payoff is not linear, I can't calculate a return. There is a contingent payoff depending on the state of the world. Therefore, I should have more than one discount rate for the future, depending on the state. Right? So in CAPM, you're only calculating one discount rate, right? You minimize the variance of a portfolio given blah blah blah. You calculate, then you have expected returns model, blah blah blah, right? And use this interest rate to discount basically anything. But for options, there's different states of the world. Different states of the world have different discount rates. So it makes no sense to use one discount rate for every state of the world. And so that's where option pricing, the entire literature, was spawned. Like you need a basically complete different way to price this thing. And you can't use capital asset pricing model anymore. So that's the big picture, right? Options is a very big, very different kind of finance and very different. And so once we get to the pricing stuff next week, you'll see hopefully clearly why we need like sophisticated model like binomial tree model or trinomial tree model or simulations to price these contracts. Can't use CAPM anymore. Okay, so let me give you the definition first. So options contracts can take in two flavors, right? Call option and a put option. So call, yes, you know, you go long. Put is the opposite, you short, basically. But the difference here, unlike futures and holding onto the asset, it's the right to sell or buy something and not the obligation, right? So again, it's you have the option to exercise purchase or sale of the underlying, but you're not required to. And so if you were to write that expression, like that, what my words down into mathematical equations, it's clearly nonlinear, right? So for a call option, it's the right but not the obligation to buy something, right? So basically, I'm wagering that the underlying asset will exceed this threshold by some amount in order for me to get a positive payout, right? So for example, sometime in the future, I have the right but not the obligation to buy. I will only exercise if it beats some threshold K. Right? This K is called a strike price. Otherwise, I will not exercise, right? If the payoff is zero, then I will not, obviously, I want to exercise if I have a negative payoff, right? So that's the idea. You can already see the nonlinear. So the interesting difference here is nonlinear. So let me write a star here. Non-linear payoff. That's number one. Number two, contingent on K versus E, T. And secondly, option has value at T equals 0. So remember your swaps our swaps discussion, nothing is exchanged, but value of the contract 0 at time 0. Same thing for forward contracts, right? Nothing's exchanged at time 0. Therefore, the contract has, both sides of the leg are equivalent in value. Therefore, sorry, this is swaps. Forward contract, same thing, same idea, it's just one period, right? Nothing's exchanged at time 0. This, of course, is a gamble, but again, because of this contingent nature, it will have a value today. Right, so let me talk about the features again. So there is what's called a strike price. This is the price that you use to kind of determine what you're wagering, right? If this is a threshold that splits the world into at least 2 states, right? Or exactly 2 states, below K and above K, right? So this splits the world into 2 states, above and below, future world. That's number 1 feature. Number 2 feature, you can either have the right to buy or the right to sell. So that's either a put. So put, right to buy, right to pay for, okay, pay K, call, sorry, receive K. And here's the right to pay K. So they're 2 different bets, just like Ford's contract, right? Relative to the future price. So the K tells you if you can make money depending on if the underlying asset exceeds that level. And lastly, there's a maturity date. And number 3, maturity date. So maybe I give you a timeline to explain to you. So at time 0, in order to get the call or put contract, you will either pay P for put or pay C, right? Because you have to buy the contract to get that position. If you are, we're going to make the world simple, okay? So let's assume there's no such thing as an option that allows you to exercise before maturity. That's called an American option. And we'll talk about that later. Let's assume that you can only have that right to buy or receive, pay or receive K at maturity. Let's make it capital T. At capital T, so this is small t equals 0, okay? Small t equals T. Then if you're put, your max K minus ET, 0. Because you are receiving K, but you're going to try to buy back cheaper. So it's minus ET. And if you're a call option, you're wagering that the underlying exceeds the K. So ET minus K. So hopefully you get to see the timeline here. Exercise only at maturity. So this is the nature. This is the timeline of the contract. Okay, so you get if you're a long call, you have to pay P or you pay C, hence the minus P and minus C. At maturity, you have the right, but not the obligation, to either pay for an asset at the price of K, so that's C, that's the call option. Otherwise, if you go put, then you have the right to sell at K, and you're going to try to buy it back at a cheaper price, hence minus ET. All right, so your question may be now like, does the underlying asset price relative to the strike price tell me the value of the call or option or call and put option? And the answer is yes. And in fact, we have different ways to name these scenarios. So when you have the underlying asset, so let's say an arbitrary small t equals to k, this is called at the money. For obvious reasons, right? It's precisely at the strike price, so you're breaking even if you choose to exercise whatever, hypothetically, if you could, right? So t is some time between 0 and capital T, right? You can call these, you can say these things about it. Okay. In the money means that if you exercise the option hypothetically, if you could, you would yield positive payoff. So for call, this would mean that ET is greater than K. For put, that means K is greater than ET. Out of the money means that you would yield nothing, right? You would not exercise. And so for call, that would be K is greater than ET. And for put, that would be ET greater than K. Sorry, I shouldn't be using capital T. I should be using small t. Small t. Or just terminology, but just hope you understand what exactly you should be thinking about, right? You should be thinking about the different states of the world when you try to evaluate how to use options contract to hedge. If K falls below, I mean, if the asset price falls below K, falls below above K, what are my payoffs? That should help you decide how to use options to manage your risk. All right, so let me now walk through these payoff structures more precisely. I'm going to write it in 3 ways. I will write the math equation that defines the payoff at time t. I will create a payoff table, and I will also plot it in a graph to show you the possible realizations of the underlying asset and what your options contract looks like in terms of payoff when I plot it against the actual price 1 period later, just like the future stuff. So a long call means that I'm paying for a call option. So I have to minus C, okay, in the beginning. But if I pay for it and I hold on to this call option, I have the right to buy the underlying asset for K at maturity T. The net payoff, without considering the cost of the initial purchase of the contract, is the following. It's a max function, again, ET minus K over 0, meaning that if this ET falls below K, I will just resort to not exercising and therefore get a 0 gross payoff as a result. So let's try to be more precise. So what I'm trying to do now is to show you what a long cut option looks like. Okay, that's the payoff. In the future, we can create a so-called payoff table to visualize what exactly is going to happen or what I want to protect myself against. So I can write payoff at time t. ET less than K, so E capital T means the underlying spot price of the asset or currency is less than the strike price. That's one state of the world, right? One future state. The other state is K is less than ET. So either the stock or the underlying asset fails to hit the K or it exceeds the K. So it's trivial to think about the equal sign. So I'm just omitting it. Right? So just below or above. Because when it's equal, its payoff is zero. Okay, so payoff at time t is minus C, right? Because I have to pay for it. If the underlying asset is below K, I will not exercise. So the max function spits out a zero. When the underlying asset price exceeds K, I will exercise and I will get a payoff of ET minus K, which is positive. I can plot this. So let me write now payoff here and the y-axis. The x-axis is the realization of future underlying price. Payoff is zero exactly at the origin in which we have the strike price K. So notice that it's K, not F, right? And let's evaluate the payoff structure given these two states without considering this minus C. So when when the spot rate in the future at time t is less than K, that means it's to the left of the origin, we have a zero payoff. So the payoff should be here. If it's to the right of K, we should have a positive payoff with intercept at K, right? So it should be an upward sloping curve like so. So just based on this picture, you can see we get downside protection and upside exposure. But that doesn't tell us a full story because we have this initial cost that we have to pay. So that's a downward shift of, so assuming there's no interest, okay, like ignoring interest earned on this, or so we shift the entire payoff curve downward because of the cost. So here is minus C, right? So how should we think of this? What does this tell us? This tells us that if you engage in a long call option, you're basically asking for two things, right? You're protecting yourself from the downside, right? So you limit your losses. To minus C, right? That's the most you can lose if the asset price goes below K. Okay? Goes to zero, doesn't matter. Your cost is just C. Okay? So it's not infinite. But you also get exposure, right? To large increases in the asset price. So you get exposure to large increase. In ET. So this triangle here is nothing, right? It goes in your way, so small changes, small positive changes, positive increases. Doesn't help. Because you have to pay C up front, right? So I guess you can say that's the price of insurance, right? So you don't benefit from small increases, but you limit your losses, but you're also exposed to the upside in the case in which the underlying asset increases in value by a lot. Right? So you can already see, right? It's a very subtle way of risk management now with options. It's no longer just blunt tool in which we try to delete all exposure. Now we can say, well, how large of an increase am I talking about with respect to the underlying asset? Which side am I trying to limit my losses of? And can I get exposed to large swings? And of course, the answer is yes. With just one set of options, one type of options. Of course, you can combine various options to get very exotic payoff structures, which is probably what you should be paying attention to for your exam, right? Can I combine various options together to get a very elaborate way to manage my risk and exposure to the underlying asset price? All right, so that's long call. You can take short call. So if you know what short call means, that just means you put a minus sign and you flip the graph like this, okay? You flip it over. So let me show you what that looks like. Because you are short, you receive C, okay? That's the difference. You get something from the beginning, but you have to now pay out in the case in which ET exceeds K, right? You're the other side of the counterparty, right? You're the seller of the call options to the buyer, and so you have to pay out during good times in which asset prices go up. But you get that C up front at least, right? All right, so let's talk about what that looks like. This is minus max ET minus K. Again, the only difference here is just the minus sign, right? But in any case, let's just be complete and also do payout table. Two states of the world, ET less than K, K greater, sorry, ET less than K. Sorry, K less than ET, yep. All right, so at time T, if I'm short call, I am writing the call so I can sell it and make revenue inflow, so that's plus C. In the case in which the stock price is below the strike, my counterparty won't exercise, so that's a 0. That's great for me. But in the case in which he does exercise, I have to pay out minus ET minus K, which is just can be written as K minus ET. We can do the same by drawing a payoff graph, again, to visualize exactly what type of, how to use it to hedge our pre-existing portfolio position. So payoff. This is ET. Origin payoff value has 0. And this origin on the x-axis is K. So in the case in which ET is less than K, nothing happens. Again, straight line. Now, on the right-hand side, it's no longer an upward sloping curve, it's now a negative sloping curve because it's minus here. So the intercept is K, but it's downward sloping. Just like the previous graph, let's try to factor in the revenue we get from selling this option. So our entire payoff function therefore shifts upwards to a higher level. This is plus C. All right, So let's talk about what exactly is going on here. So here you also get protection in two places. You get a nice revenue here, and with the case in which the underlying asset doesn't exceed the strike, right? So that's here. So this is uh this is profit, fixed profit, okay? Yeah. But you also get insurance in the case for small changes, for small increase. I won't say insurance, protection. Okay. Protection. Protection for small increases in ET. But the cost of this fixed profit plus this protection for small increases, of course, is that for large increases, I am still exposed. Exposure to large increases. Right, so hopefully you see the trade-offs, right? You get a nice revenue up front, great. Your profit, however, is capped at C. That's the most you can make, and you're hoping that the underlying asset doesn't increase. If it does increase, that's okay, because the profit that you get up front offers you some protection for small increases, so you can still yield some net revenue, right? However, for large increases, that's gonna be a big problem. So you can see that the trade-offs is more subtle, right? All right, last thing I'm gonna do is go over the puts, and then we will pause there, because that's where I stopped yesterday. So let's do the puts now. So long puts means that you have to pay P up front, but your payout function looks like this. Here you have the right to sell to your counterparty at K, but you're hoping that you can buy back cover at a lower price than what the market can offer. So let's go ahead and look at a long put, which is a max K minus ET, otherwise zero. Let's do payoff table. Payoff by time T. ET is less than K. K is less than ET, two states of the world. Because I am buying put, I will be subtracting P. And the payoff therefore is K minus ET in the case in which ET falls below K, because I will exercise. Otherwise, nothing. The payoff structure graphically will look like a mirror image from left to right, right? When you short and long, it's always up and down. Long and, sorry, put and call are the left and right mirrors. The payoff is here. Payoff. This is E1, ET, zero payoff, strike price K. If it's to the right of K, it's zero. If it's to the left of K, it's a positive, sorry, downward sloping curve, but it's positive payoff. Factoring in this P, the curve shifts downward. So this gap here is a minus P. So what's going on here? Well, just like in the first discussion on long haul, you have downside protection. The downside is when when the underlying asset price increase. So here you have downside protection or losses are limited when asset price increase. You have this is exposure. Sorry. No benefit, no real benefit to small changes. So you're trading off this betting there's no small decreases in the underlying asset. And then you have exposure to large decreases. So large upside exposure to large decreases in asset price. All right, last one. For short put, you get money for selling something. Your payoff therefore is just minus the long position. So the put diagram would therefore look like this. K minus ET 0 to the graph. ET less than K and K is less than ET. Payoff is plus P, right? Payoff when it falls, it's minus K minus ET, which is equal to ET minus K. And then 0. Right? Graphically, it will look like this. Won't be so large. Payoff. This is E1, K, 0 payoff. So not accounting for the cost, the benefit of selling the put in the beginning. Let's do the gross payoff first. So 0 if E is to the right of K. And then if it's to the left of K, then it will be an upward sloping curve. Like so. And then, of course, when we account for P, we shift the entire curve upwards. So here is plus P. This is a fixed the payoff. I write payoff, fixed payoff at P. Or I just write cap. I think it's more appropriate. Capped. So your payoff is capped, but you get downside insurance, right? Small increases, small decreases. Protection. So protection. Awesome. All right, protection. But then you're still screwed for this side. So exposure to large decreases in asset price. All right, last table, which summarizes what I just did. And of course, I will compare it with forward contracts. So this is forward contracts, this is forward contracts. So review again for asset positions, meaning that you're planning on liquidating something in the future. You want to protect drops in value of your asset. If you want protection for the downside, you can sell forward, short forward, but you get a fixed quantity as a result, which means you have to give up the upside. For the options situation, there are two scenarios to consider. If you want protection for large drops or protection for small drops. For small drops, you can sell call. And you give up upside, yes. Because again, you get that protection, right, in the opposite direction, but that's all you want, right? But you have to give up the upside. For large drops, you can buy put, and you don't have to give up the upside. Same things for liability. Again, if you have a liability, you want to prevent large increases in your liability value, and you can engage in a long forward to eliminate exposure, but you have to give up the upside. Whereas for options, you have two choices. You can think about protecting against large or small increases. Small means you should consider selling put. Otherwise, buy call for large increases. And of course, selling the put gives you that premium, right? Gives you that payoff in the beginning, which gives you some protection, but your payoff is capped. But when you buy a call option, you have the upward exposure, right? You have the upside exposure, but only if there's large increases in the other direction. All right, so that's all I want to cover today. Next week, I will I'll give you the graphs for hedging. I will also talk about option pricing a little bit, and then finish up next week's class with discussion on cryptocurrency. But rest assured, I won't talk about computer science or anything like that. I will just talk about pricing. So I'll talk mostly about options on futures for various currencies, not only for fiat currency like euros and Japanese yen, whatever, but also crypto on Bitcoin. So there are options on futures for Bitcoin, which can give you some insight on how people think we should value Bitcoin. All right. All right, so that's it for today. If you have questions, happy to talk to you after class. Please sign in the attendance sheet if you haven't already. Otherwise, I'll see you guys next week.